Hi, I hope everything is going good and everyone is feeling well. Let's continue with our topic of R&D tax credit. Today we will deep dive into the MAS scheme and the RDEC rules and how this works with a real example so that you know how to calculate the RDEC and what is the MAS scheme, everything. So this will be helpful for your knowledge and whoever is working on the UK tax. So the new MAS scheme is a UK R&D tax relief regime that is applied after 1st April 2024. This scheme combines the old R&D SME scheme and the RDEC into one main scheme which is applicable to most of the companies. Who can claim the MAS scheme? So the MAS scheme can be claimed by most of the companies regardless of their size. That means SMEs and the large companies as well. So who are the large companies? The same threshold, like if the company is having an employee greater than 500 people, or the turnover is greater than 100 million euro, or the balance sheet total is 86 million euro, then it will be considered as a large company. Now, there is an exclusion and there is a exception as well. Let's dig into the exclusion and then I will come to the exception. So who cannot claim the R&D relief? The individuals or the sole traders, partnerships, or any overseas companies who do not have any permanent establishment in UK cannot claim the R&D relief. Now, who can claim now? The UK companies who are subject to the corporation tax. Companies carrying out the qualifying R&D activities includes large companies and the SMEs. Both can claim the MAS scheme, but there is an exception in the SMEs that the R&D loss-making, R&D-intensive SMEs cannot claim under the MAS scheme, which I am coming after these slides. And any overseas companies with a UK permanent establishment and the UK tax liability can claim the R&D relief. So if a small company is still making a loss and incurring a huge chunk of money on the R&D activities, then UK government provide them the cash support instead of pushing them into the standard RDEC norms. The government kept this special regime to protect the startups, innovation heavy businesses, or the business who are incurring a lot of money on the R&D activities. Because these businesses is required the cash support because they may have the losses in the initial stage, right? Or they rely on the cash support to survive their business. So the government kept this regime so that they can get a cash credit to survive their business even when they are in the loss-making position. So there are 3 conditions to qualify as a R&D intensive tax regime. What are those conditions? Let's have a look. The conditions are obviously must be an SME, must be a loss making, and the third one is must be a R&D intensive. What does that mean? That means R&D expenditure should be greater than equal to 30% of the total revenue expenditure. So under this regime, company will get a cash credit of 14.5% on the qualified R&D expenditure. Now, why does it matter? Because under this intensive regime, the focus is on the cash support. So provide the faster cash or fund to those loss-making SMEs. Whereas in the RDEC, the credit is taxable and then it will be offset in the different stages. So that is what the objective of the government, to provide the cash support to the loss SMEs in a faster way. So the MAS scheme is based on the RDEC model, meaning that relief is an above the line credit. What does that mean? It appears as an income in the profit and loss account, so boosted the reported profit and is taxable as a trading income. Credit rate would be what? 20% of the qualifying R&D expenditure will be allowed as an RDEC, but the credit is taxable, so the net benefit is 15% after corporation tax. Let's walk through some examples to understand how the RDEC works in a real life. Now let's look at the scenario 1. So here the qualifying R&D expenditure is 100,000 GBP and the accounting profit is 500,000 GBP. So first we calculate the RD credit, which is coming 20,000. Now the step 2 is what? 20,000 will be recognized as an P&L and net accounting profit will become now 520,000. So the corporate tax will be 25% on 520,000, which will be 130,000. So the net benefit is coming what? 20,000 into 25% is 5,000. That means you have paid the tax of 5,000, and so the net benefit is 15,000. So if you are a profitable SME, you can deduct this 20,000, the RDEC credit, with your outstanding tax liabilities. But please note that your net benefit is 15,000 after tax, because you already included this 20,000 in your profit and you are calculating 25% tax on that. Coming to scenario 2, it's a loss-making company. So company having a loss is 100,000 and qualifying R&D expenditure is 100,000. So RD credit will be how much? 20,000. Accounting loss will be reduced by 20,000 because 20,000 will be recognized as an income. So the loss will be 80,000. Now the credit, as you have a loss, so that credit can be either utilized for any other outstanding tax liabilities, or you can claim it as a cash credit. So the net benefit again will be 20,000 is before restriction, but after tax it will be 15,000. So the takeaway is like loss makers also have a benefit, but cash may be stacked. Like you cannot get the tax upfront. Like you have to file the RD claim, then the government will evaluate all your R&D projects and claims, and then government will check if there is any outstanding tax liabilities. If there is, then they will adjust that refund with that tax liabilities. Otherwise, they will pay it. The next is a very good example. It is one of the comprehensive examples. So let's look at this. So here you can see there are many costs. So one is a staff salaries for R&D, which is 100% relevant as a qualifying cost. So that will be considered total 800,000. EPW cost, that means you have outsourced R&D staff, and as we learned that 65% we can claim, so it comes 78,000. Electricity and water used for R&D, so out of that 60% you have used for R&D, so 60% isn't claimable. Material and consumable 100%. Rent and rates for facilities that you cannot claim, we have learned. Cloud and software license, etc., which we can claim as 100%. So total qualifying R&D cost is coming 10,58,000. Now you compute the RDEC based credit. So 20% of 1.0 million is coming to 211,600. So that is your gross RDEC. Okay, now you will add this in your income, right? So you can assume that your profit before RDEC is 2.5 million, and after adding this RDEC your profit becomes 2.7 million. So you will be calculating your corporate tax on 2.7 million, which will be 677,900. So now your tax will be getting reduced by 211,600, which is your tax credit, and your total corporate tax will be coming 4,66,300. So even though the credit is 20% of cost, after corporation tax your credit is 158,700, and that's correct, right? Just think this, like 211,600 this credit you have added in your income and you have calculated tax on that. And now when you are reducing your tax liabilities, you are considering the gross RDEC. So already you have calculated the tax on this 25%, and then again you are reducing this from your tax liability. So your net benefit after tax is 75% of the RDEC, that is 158,700. So that is roughly 15% of qualifying R&D spent. I believe with all of these examples, now RDEC rules are clear to you and the mark scheme as well. However, if you have any question, you can comment it and I will reply back. Thank you so much for watching.